Our next presentation deals with an approach to promotions that brands should be taking. Our presenter is Chris Frericks, Client Director at Quotient. Chris, take it away.
Thanks, John. I appreciate it, and welcome everybody. John introduced me as a client director, but I'll tell you what my role, frankly, typically is. It's more so to help brands, right? My role is to help brands, whether it's an objection of trying to increase awareness around a certain product. They may be looking for insights into how their promotions are performing. And towards that end goal, what I want to do today is help you all, right? So it's my goal today to help give you an outline, maybe outline a strategy that can help you achieve better results through couponing on your brand. Okay, so the title is A Bold Approach to Couponing That Brands Should Be Taking. Just in terms of qualifications, prior to coming to Quotient, I spent the first 9 years of my career working in brand management for Procter & Gamble. So I sat on both sides of the desk, both buying couponing products as well as selling couponing products. And I'll tell you, over the past 11 years or so, I frankly have now uncovered a couple of insights I think we can all be looking at towards applying to the business and ultimately achieving better results. I know they had covered a couple of ground rules on the upfront on the presentation. My set of ground rules is this. We needed to use a new lens. And the new lens is this. We're going to talk a lot of concepts today that may be new to the world products or maybe just new to you products. A lot of these products are digital within nature, okay? And with a new lens around these digital products, think about breaking down the confines of what you think about of a coupon or a promotion today. In many of our CPGs, couponing can be a dirty word, right? And I say it's almost a dirty word because it's saddled with certain results over time that many folks within the organization may say are not the most glamorous results to socialize. Okay, but let's break it down. Let's use a new lens because, frankly, digital is delivering different results, and it's using different cost models to go and get those results. So no longer should we be applying the same lens that we've used with traditional couponing products towards the new world in digital, okay? To the lens on different results, okay? I thought I'd start with just a little bit of an orientation. Digital is different. Why? Because it has enabled in many ways, not only couponing, but in many different digital marketing vehicles, it has enabled brands to get to cost models that reward based on pay for performance versus pay for distribution. Okay, so the simple way to think about this is within digital products, most products are set up on some sort of cost structure whereby the CPG pays only when some consumer engages with that product, okay? Conversely, if you think through traditional marketing tools, this could be the case for direct mail. It's certainly the case for newspaper coupons. It could even be the case for TV advertisements, right? You're paying for a certain set of distribution, and that certain set of distribution gets pushed to the masses, whether it's relevant to your target or not, okay? And from a general perspective, marketers are learning that with most digital products, and certainly true for couponing, they're getting better results, okay? They're getting better results, and that's great. What we're seeing in the couponing space is brands are tending to layer on these new tools that they're trying out, and they're layering them on incrementally and not being choiceful based on what the results are telling them, okay? So to help illustrate, I pulled a little bit of data, and the data comes from an Inmar study back in 2009 that showed that the average brand was basically investing in around 5 couponing tools, with the newspaper being about half of that total investment, okay? When you flash forward to 2016, the number has doubled to about 10 total tactics, right? Why has this happened? Brands are getting better results. Brands want to continue using these new digital products, right? So if you look at the growth over the past 7 years, the growth is being driven largely by the new digital forms, largely at the expense of some of the more traditional newspaper forms. And what's going on are brands are now executing more and more couponing tools versus being choiceful and guided based on what the data is telling them, okay? So from a setup standpoint, I think brand marketers are now feeling saddled with how can I continue to have so many different couponing forms in market? Should we now start to be choiceful based on what the data is saying? And we'd lobby certainly yes. Okay? I started with, I want to give you an outline. And I wanted to give you an outline to help think about your total results on the business. This is frankly my first slide where I'd ask you to hit the pause button, set down the cup of coffee, and if you want to think about the output of how can I help my brand, here's how you do it, okay? On the outline, what are we driving towards? Our goal is to get better results from our coupon investments, okay? My recommendation is for your organization, how can you help the organization see the value in taking a results-oriented approach to couponing? Today, brands may be moving more volume with increased couponing spend and number of tactics, but, and this is the aha, okay? Key takeaway number one for me is what brands should be doing is moving both more volume and reducing their overall couponing spend. So I'm going to step back. All right, I started with what's the goal? The goal is to get better results from your couponing investment. And this is somebody who works for what is sometimes considered a couponing company, is stepping back with a recommendation that says, number one, you should look for moving more volume, not a surprise. But number two is reducing the overall couponing investment. Success looks like doing both, not being choiceful with one versus the other. Okay, this is the real aha and the crux of what I think you can help do to improve your brand's results. Nobody wants to spend more than 15-20% of their total marketing budget on coupons. And by the way, that number sounds big, but that's what brands are spending today. How do we take that number down to 10 to 12%, yet still move more volume than we're doing today with 20% of our investment? So, what do I mean exactly by taking a results-oriented approach to couponing? What I mean is don't start your plans next year by looking in reverse and saying, what did I do last year? And simply anniversary those plans with a minor tweak, okay? That was planning in the past. Planning in the future says, let's start from scratch. Let's take the results that are giving me the outcome that I desire, and let's spend a saturation on those tools that are giving me the results that I need to move my business. Okay, I'm going to make it very clear. I think there are only two variables to consider. As you think about the 10-plus options that brands are investing in today in the couponing space, you ask yourself two things. Can the tool give me the scale that I need to move significant volume and move the needle on my business? Yes or no? And can the tool deliver an acceptable ROI such that I want to invest in it going forward? Okay? And what you want to do is you want to find the sweet spot of tools that deliver both. If it's got scale, if it's got the healthy ROI, you spend a saturation in that tool first before you move down your list of cascading choices across your brand. Okay? To be clear, crystal clear, traditionally speaking, the newspaper FSI has delivered the scale to move volume. There is no question about it. Okay? It has been questionable on its ability to deliver return on investment. And then on the converse, historically, digital products have delivered healthy ROIs, but the question has always been, can they deliver the scale to move volume? Okay? What I showed on that prior graph with the transition from more traditional tools to digital tools over the past 7 years is the fact that what's new in the digital world is not only is it delivering on the ROI piece now, but delivering at scale today. There's no question about it. Digital has reached its age. It's delivering at scale. And what we don't want to see brands doing is being held hostage to tools because they think there's no other option to move the scale. Right? And they're being held hostage to deliver the volume despite the fact that they're spending significant budgets on poor return assets. So the obvious question has to be why, right? So why are brands doing what they're doing today? And frankly, as a former brand guy, I was in this seat as well, right? I loved coming in on Monday mornings and looking at the spike in my business that occurred behind investment in the newspaper FSI. I loved it, okay? And I was just like my colleagues who were addicted to seeing this spike from what we called merchandising, right? So we invested in the FSI because we thought that it delivered merchandising, and sure enough, as the shares came through, we would see a spike in our volume and a spike in our share, and we were happy about that. We loved it. But the fact is, there's a significant amount of investment that goes into delivering the spike from quote-unquote merchandising, right? There's a lot of different investments, both from marketing teams, both from sales teams, and the fact is nobody has full visibility or cost transparency to what the other teams are spending. And what ends up happening is with a lack of transparency to total cost, you end up assuming that your cost or your activity stream achieves the result in which we're staring at within the shares. Right? So you got a lot of investment. I'm not sure that either side really has the full visibility to that. And what you're doing is you're left just taking a look and assuming that your activity is what caused that spike in business. And the simple illustration to help see this is, and I fell into this camp absolutely, I'm guilty as the next. Okay? As a marketer, I loved coming in and seeing that volume spike. And I can vividly remember turning to my colleague within the bullpen and saying, look at our shares this week, look at what my coupon did to our volume, and we would sit there and high five. Now, I told you I worked in a lot of different brand management roles. I also worked on customer teams for Procter, and I've seen how the sales organization works as well. On that same Monday morning, looking at the same volume spike, I see the sales guys who are also looking at one another in their bullpen, and the sales guys are looking at each other saying, check out what my pricing, either a TPR or a temporary price reduction, did to our volume. Right? These are layered investments. They're both layered on the same activity stream, driving the same result. Right? And the real killer is when you're working on the customer teams, you see what happens in the supply chain side. So we're looking at the same spike from three different sides of the organization. You got the marketers high-fiving, attributing that spike to their coupon activity. You've got the sales guys high-fiving and saying, look what my pricing has done. And then you've got your supply chain folks scratching their heads saying, oh my gosh, out of stock, missed opportunities to close additional volume with just having product on the shelf. So these guys are really raising a great question. The supply chain team is saying, you know what, is this spike really healthy to drive the business long term? And I bet you if you ask the general managers across your brands, they're probably going to say, I'd rather have slow and sustained growth versus spike-driven growth. Okay? So let's take a step back, right? And let's take a look and do a double click. I told you there were a lot of different costs, and these costs were layered on different investments. So why don't we take a double click at these layered costs and understand, do these costs pay out or do these costs not pay out, frankly? So there's certain costs that the marketing team has cost visibility and responsibility over, and there's certain costs that the sales team has visibility to and responsibility over as well. Okay? I've put in some numbers here for illustrative purposes only. What I would ask is I would probably pay less attention to the specific numbers, and I would pay more attention to the key takeaways as a result of the total data shared. So let's take a look at marketing first. Okay? Marketing's got responsibility for any coupon-related costs, and there's generally two buckets, right? One most brands would call the fixed cost, and one would call the variable cost or the working cost. Within distribution, right, it's roughly, if you want to send a one-page FSI out to 35 million households, you want to think about the creative and the coupon creation, it's somewhere in the neighborhood of $200,000, right? And then if you want to put, of course, a coupon within that creative, let's say you got a $1 coupon in the newspaper, you're going to assume about 0.5% redemption rate or so. You can do the math, and you can see you're roughly another $200,000 or so within marketing's cost, right? So that's the cost that the marketers have control over. That's the cost that they are modeling their returns based upon, but it's not the full cost going into driving that spike. If you think about we do this for merchandising component, the sales teams are responsible for any pricing or costs that are associated with merchandising. And generally speaking, there's three different costs that go into merchandising cost. You have pricing, or TPR cost, okay? You have feature and display costs that the retailers generally charge CPGs for participation. And then occasionally you have a make good cost. And I'm going to start here at the make good cost at the end because you don't hit this with every execution, okay? What the make good cost reflects is simply when one retailer feels disadvantaged as a result of some pricing activity within the market. Okay, the best example is Walmart feels like they were beat on price by a drug retailer, and Walmart comes after the CPG with leverage, looking for some sort of increased or added additional investment beyond what they've given as a make good for getting beat on price within the market. Let's go back up to the cost that sales has responsibility to that we probably all see in direct correlation to the volume spike. The first is pricing cost, okay? And this is generally speaking a variable cost based on how many retailers are going to activate and then how many consumers are going to buy your product. But just for relative terms, right, if you got 5 retailers activating pricing cost and you're looking to, maybe move somewhere in the neighborhood of 35,000, 40,000 units at each one of those retailers at $1 per unit moved, you're looking at a cost somewhere in the $180,000 range. Now, layered onto that TPR cost from a sales perspective side is think about the costs that are required in order to secure feature in the retailer circular or to display your product on their end caps in store. Okay, both typically have costs, and if you're assuming another 5 retailers are going to activate with merchandising, either in the feature or display, you're somewhere in the $200,000, $225,000 range for that activity. Okay, so marketers are looking at the cost in yellow, sales folks are looking at the cost in pink, yet they're both looking at the same result from a volume standpoint, and they're attributing that volume spike and the ultimate payout calculations based upon the cost that they have visibility to and the results that they are seeing. So, aha number 2 for me, right? If you're thinking through what are we trying to do and what's the outline that I'm proposing, we talked about the goal of getting better results from coupon investment by being choiceful based on, does my couponing activity have the scale to move volume and does it deliver an acceptable ROI? And then we talk through how can I help you push back with the right data to help understand if my total investment is paying out for us. This is the insight that I think you can come and show up with to your finance person to make finance your best friend as you look to implement a strategic shift on your brand. It's simple. What I just showed you is a simple analysis that indicates that, roughly speaking, the exact numbers, again, are going to change brand by brand, but for every $1 that your marketing team is investing and also modeling their ROI based upon, another $1 is being invested by the organization for the merchandising spike. This is an aha for me. It's an aha for how I used to run my business at P&G. And I think it should be the basis of how can you make the right folks within the organization clear upon how do we get better returns, right? This one-to-one relationship guaranteed does not pay out. And I'm going to give you a double click to help understand why that's the case, okay? So what I want to do is give you the data to help you push back. The one-to-one is one example of how you could help show the data for your organization. This next analysis is a really simple one, okay? I'm going to call this the Jerry Maguire show me the lift or show me the money slide, okay? And it's as simple as this. You take your brand's volume, you take it on a weekly basis, and it looks somewhat like a pulse check throughout the year. Okay, so I pulled a sample brand and I blinded it for this purpose, but we just looked at weekly volume from July of 2016 through March of 2017. Okay, so these are weekly volume trends, and all I've done here is added a gray trend line to show you what the average weekly unit volume is on this brand. Okay, you can do this in 15 minutes if you're sitting on the brand side, and what you're trying to do now is take your average volume and you're trying to just get a very high level view of what's the attribution to certain activity streams. Okay, So the first activity stream that I would suggest layering in is what I would call first-of-month merchandising windows. Okay? And why do I say first-of-month merchandising windows are important to layer in? These are the merchandising windows that traditionally sales teams are spending additional dollars to help drive merchandising. And what I've layered in are simply the first-of-month merchandising windows where this brand did not have an FSI coupon. Okay, so what you can see here is there's a delta between the business performance on an average run rate and the first of month. Okay, it should not be a surprise to your leadership and to your finance and sales teams that businesses spike around first of month. Why? The two reasons are simple. Consumers have the paycheck, right? And secondarily is that is when the highest concentration of merchandising activity happens across retailers. So what you have here is you can quantify what is the base lift from just trade investment around first of month merchandising when I don't have a coupon in my FSI. That's layer number one. And layer number two, you then double click and say, okay, now let's take a look and add in blue. And blue represents those first of month merchandising weeks where the brand was present with an FSI coupon. Okay, and there is another lift, which is good. You'd want to see an additional lift with the additional investment. That's certainly good. What you can see is now you can start to quantify what is the lift from the different activity streams. So what we're looking at is a 9-month period. In this case, the brand had 2 newspaper coupon drops in 7 months where there was first of month merchandising content, but there was no coupon within the FSI. Couple of takeaways for me. First is the biggest jump in terms of base volume. The biggest jump is directly attributable to that first of month merchandising. Okay? That's your highest correlation with volume spikes. You can see it clearly if you look at just the red dotted lines that go vertically across this graph. With every first of month merchandising window, there's a spike on the business, some higher versus others. And even the highest spike of the year in August of 2016 occurred on one of these first-of-month merchandising weeks when the brand did not have a coupon present. Aha number 2 is absolutely the business responds when you have what I'm labeling here as the blue dotted lines. And the blue dotted lines is simply a newspaper coupon present on this brand. So you are driving additional units. The results can be mixed. They are both superior to the red lines, but they're not driving as much volume as the first of month merchandising is itself. Okay, so the next simple question is my activity stream paying out or not? And once you have the units behind this chart, it makes it really simple to start doing math to say, what is my lift in terms of how many additional units am I driving? And then does that lift pay out when I consider the totality of my investment to get that lift? So for illustrative purposes only, I'm going to give you a couple of sound bites, okay? And pay less attention to the specific numbers on the slide and more attention to the overall context. I would tell you the context is not going to change based upon your brand and your cost agreements. You're going to have different numbers that fill this chart up. But what I would do is, excuse me, I would simply look at what am I paying for my lift within the FSI. And that's column number 1, okay? Column number 1 says, generally speaking, I'm moving X number of incremental units at a total cost we talked earlier of roughly $400,000 worth of marketing investment. Based on the average price point of your unit, you're able to calculate a return on investment. In this case, it happens to be $1.24. Now you build this and you do the same analysis using your digital supplement or what I'm recommending, your digital alternative. Okay, and if your goal is to drive the same number of incremental units, what you're solving for is, can I do it at a better return? And if I can do it at a better return, I should be investing there first before I put dollars towards an investment choice that's not delivering a superior return. So look at the digital side. I need to drive the same number of incremental units, in this case $171,000. With this brand, they're able to do so with $194,000 worth of investment using the same exact payout, one versus the other. In this case, they're getting a return roughly 2x that of their traditional newspaper FSI. It's not always going to be 2x. Okay, this may be more on the extreme end, but what you got to take away is that generally speaking, digital is continuing to show that yes, it can pay out, but what's different now, why are brands investing in the FSI? Because they need the scale. Digital can deliver parity in many cases for the scale of total FSI. Okay, so that's what's new in the space. What's new is you can deliver both the scale as well as the ROI, and if you can deliver those two choices, you should be investing there as a first priority until you're at the saturation point before cascading down to other choices. So let me wrap up, and I'd love to take a couple of Q&A at the end. Okay, I've talked a lot over the past 35, 40 minutes or so, but what I would boil this down to is talking three key takeaways. As you're sitting on the brand and thinking, what am I going to do going forward to drive volume on my brand? I would encourage you to go digital and take a results-oriented approach to your plans. Start from scratch. Okay? You want to start from scratch and frankly implement today because you're now at scale. Point number 3 is all about let's question everything as it relates to the FSI. If you're going to put a new lens on your digital products, I want you to put a new lens on your analysts with taking a look at what's the result that my FSI is driving. Is it truly delivering merchandising that's incremental? Or is it that the added investment from your sales folks investing in that merchandising is what's delivering the incremental piece? The key is, at the end of the day, if you can get better results with a lower cost product, what you're able to do in that case is deliver better results and reduce your overall couponing spend. Okay? So I gave you a framework, and the framework was as simple as this. Your goal as a brand marketer is to get better results from all investments, couponing being just one of them. I'm lobbying that we're choiceful based on 2 simple criteria, and digital can deliver on both of these. The first is, do you have the scale needed to move the volume that moves the needle on your business? And the second is, are your choices delivering an acceptable return? Now, of course, when you go down this path, you're going to encounter roadblocks from somebody throughout the organization. I want you to be prepared to push back with data. And you can think about 2 pieces of simple data shown. Number 1 is this layered investment between sales and marketing, layering their investments to achieve a common result. And second is that Jerry Maguire, show me the lift slide. Okay, I've run it on 20 or 30 brands, and I can tell you that the trends are generally speaking consistent across every one of them. You're going to get some variability, right? But what you're going to see overall is, generally speaking, you're able to show better returns with digital products. And ultimately, in the end, what you should expect behind that as your reward is a more stable path to business growth versus one that's more spike-driven. And ultimately, what that's going to allow you to do is extend your investments to drive the household penetration, to drive the volume, to drive the awareness that you need to sustain your brand for a longer period of time versus concentrating all of your investment into a single Sunday. So with that, I think we have about 5-10 minutes left. I'd love to open it up for Q&A.
Sure, we have several questions here for you. The first one, what brands and or retailers are doing the best job of balancing traditional and digital spend to grow ROI as well as volume?
It's a great question. What I don't want to do is cite specific brands that I work on directly, but what I would tell you is take a look at the Sunday Circular. Okay? One of the brands that I've seen within the Sunday Circular is a Procter & Gamble brand. And as you take a look at some of the choices that that brand is making, you can see it in the brand saver each and every week as the brand is pulling out physical coupons within that FSI, right? The organization still feels like having the soundbite that we have in FSI is needed to secure merchandising. they're still dropping an FSI, but they're stripping out redemption dollars by not always including a coupon within that execution. Take a look at the next Sunday brand saver from P&G here in a couple of weeks. Take a look at those brands who are following that approach, and I tell you that's a nice place to start with brands who are taking a balanced approach to getting the most out of both digital, yet still reaping some benefits the FSI can offer.
Okay. Another question. FSIs seldom drop without trade support, but it would be interesting to measure the lift of coupons alone. I guess that's more of a statement, so can you address that?
I couldn't agree more. I think what we know is coupons have a direct link to retail sales, right? They have a direct link to volume. It's very easy to quantify what is the volume by which a coupon could deliver. Now, it's a little bit more convoluted when you think about the FSI space because of the layered investments we talked about, right? It's very seldom that a brand, like you say, only has a coupon, and we can attribute the business result to just that coupon. More often than not, what we should be doing is taking a look at all costs that went into the execution, and based upon the total cost, piecing out as much as we can or breaking out the benefits of the merchandising and simply doing a look at the couponing piece. That's what, as I'm calling the Jerry Maguire show me the lift slide, that's what that analysis is frankly designed to do.
Okay, another question. Which digital works best and effective for CPG? Text messaging, branded app, website, etc.?
Yeah, I think ultimately the results are going to vary based upon your brand's objectives. So what I would tell you is take a look at what your objectives are, talk to your leading suppliers that may offer products to deliver against those objectives. If you want to think strictly back to this slide, let me go back here just a few slides. If you give me just a second. If you think back to this slide that I shared earlier, the puck is indicative of two things. One is the digital pie is growing across multiple forms, and the biggest growth that we see within the digital segment is within a space we call the load to ID space, or offers that are loaded into shopper loyalty cards. That's where you're seeing the biggest growth within the space today.
Okay, another one. I understand how the FSI can drive spikes in volume, but how does digital coupon spend provide more consistent growth?
Yeah, it's frankly as simple as this. The FSI is concentrating all of your investment into Sunday. The digital space is concentrating your investment not into one day, but over a broader period. So instead of your 100,000 redemptions coming all within a few days following that Sunday newspaper drop, your 100,000 redemptions are coming over the course of a 3 or 4 week period. And over the longer period, you of course are smoothing out the spike and realizing that benefit of the couponing content over just a longer period of time. So instead of having a business that spikes up and falls back down, you have a business that continually ticks up.
Okay. Another one, how does the increase in e-commerce and click and collect impact the coupon space?
I think it's a great question. I'll tell you the e-com retailers are who I'm going to address first. The e-com retailers are figuring out couponing. They're not going to be left behind and disadvantaged to brick and mortar retailers by not being able to have couponing platforms. As a company, Quotient powers some e-com retailers' capabilities online. Other spaces, let's say the Amazons, have separate couponing platforms. They're just not broadly known by consumers today. And if you think about the awareness of the FSI couponing being the highest, digital forms being slightly below, the awareness of online offers at e-com retailers is certainly the frankly lowest and is likely going to lag for several years. On click and collect, you can still use coupons, right? So many retailers, I live in Cincinnati, Ohio, and Kroger's a hometown retailer. They offer a click and collect program, and shoppers simply indicate, do you have coupons on this purchase? And as you pick up your groceries, you are able to hand the coupon's over, and those come off the till before you tally. Both digital as well as paper, by the way.
Okay, one more. I'm assuming you are seeing significant growth behind digital promotions. What are your observations to what has led to this success?
Absolutely. I think it's a fantastic question. The landscape is drastically different than what the landscape was when I started my career in 2006. In 2006, virtually every brand invested in one couponing tool, or I shouldn't say one because the slide said up to 5. But generally speaking, your investment was concentrated within the newspaper FSI, okay? And your investment was concentrated there because of 2 factors. Number one is the retailers generally did not have an alternative platform for you to invest in. And 2 is that was the primary source of where the demand was coming from consumers. What's changed over the past 11 years is 2 pieces. First is retailers have established new platforms. Okay, so think about any retailer today generally has an application. I'll use Target and the Cartwheel app as one example. Retailers have established new platforms by which they can connect to consumers and deliver value through those platforms. Secondly, think about what consumers have done. Consumer awareness is still relatively low, but it's significantly more than it was in 2006. And you have both more retailers offering platforms, more consumer demand coming towards those platforms. The 2 of those coming together are what's driving the growth in the space.
Okay, one last question. How should digital efforts be tailored for mobile customers?
I think it's a great question. You should think mobile first within your couponing strategies, right? I'm going to give a self-plug back, but 3 years ago, Quotient had invested in a new technology platform called Retailer IQ. We saw the puck headed towards mobile capabilities and mobile products. We invested in this space, and it's a mobile-first platform for that reason. How do brands activate through it? You can activate in a number of ways, but what I would say is what you want to think about is how does the paperless couponing space look like from a demand standpoint with your shoppers? I think most brand marketers are going to be shocked at the scale at which the mobile platform can deliver today, and you start simply by having offers on that platform.
Okay, Chris, your presentation certainly generated a lot of questions, which speaks to how excellent it was. Thank you. If you have other questions from the audience, you can direct them directly to Chris. His contact information is on the screen right now.